Well, hello and welcome, Marshall Reddick investors. Thank you for joining us today for our amazing webinar on 1031 exchanges. It is my pleasure to be your co-host today. A little bit about me. My name is Sherry Brebner. I've been a licensed realtor with 20 plus years background in residential real estate, assisting clients, both buyers and sellers. I've also had 7 years of experience in financing residential real estate, as well as my own personal property buys and sells for fix and flip, encompassing 3 states over the last 20 plus years. So I really do live, speak, eat, think, talk real estate. So just for those of you who are not already familiar with Marshall Reddick Real Estate, we're a full service real estate firm headquartered here in beautiful Newport Beach, California. We were founded in 1979, so we've been around a while. And what sets us apart is really our 3 separate divisions. Marshall Reddick is not just a real estate company. We have 3 separate divisions allowing us to serve all the real estate and investment needs of our clients. We have the 3 divisions would be a brokerage, property management, and private financing. So what does that look like? With our brokerage division, we're able to help buyers and sellers locally here buying and selling their primary and investment properties. We're also able to help our investor clients purchase in one of our 16 out-of-state markets, which we'll identify here in a little bit. We also have a property management division, and that covers everything from A to Z. A lot of our investor clients don't want to be landlords or managers. We take that burden away from them. We handle everything from the prep work, the leasing, renovations, maintenance, anything and everything that has to do with managing your investment property. We take that off of your plate and we take on the burden and you have the benefit. So private financing. So we have a division that allows both borrowers and lenders to come together. As a borrower, you're able to borrow from us for fix and flip transactions. As a lender, you're able to lend out money for those who need the fix and flip transaction financing. Being full service, we really are able to meet 100% of all of our clients' needs with these 3 major components in place. Let me talk a little bit about our 16 major metropolitan markets. You'll see on this slide, the boxes, the green boxes, are where we actually have physical Marshall Reddick offices, also known as boots on the ground. We have also identified markets that are very investor friendly. In these markets, we have third-party teams that we partner with to serve our clients as well. So as you can see, we really do encompass a huge portion of our metropolitan markets within the United States. And it's our job to be on the lookout and understand and advise you on where and how to invest. We are fact-based investment consultants. We look at job market, we look at vacancy rates, economic diversity, housing affordability. Is it landlord friendly? And also we look for reliable property management. We need to provide that for our clients. So we take all these factors into consideration. What can you expect from a consultation with us as advisors? Well, a little bit about what we do, what I do as an advisor. My job is to go over the who, what, when, where, and how with you. We have an entire process where we start with your goal setting. We evaluate what your options are, your time frames, criteria. We help you identify the markets. And we have a team. We introduce you to all the key players. We have put together a team of experts on every facet of your real estate investing journey. And we set up your power team for you, and which could very well be what we're talking about today, which is a 1031 exchange. Okay, so a little bit about us and me and what we've done, but let's jump to the main event. It's right now my pleasure to introduce Dino Champagne to you. She has been a partner with Marshall Reddick for over 20 years, and she is the go-to expert for your 1031 exchanges, having facilitated thousands of transactions to date. She's based locally here in Southern California and is always available by phone or in person to assist you, answer questions. So with no further ado, Dino, it's my pleasure to hand it over to you.
Thank you, Sherry, for introducing me. It's my pleasure today to go over the 1031 process for everyone. I've been involved with the Marshall Reddick group since 2002, I believe. So it's been quite a while. And I enjoy my affiliation with you guys. All right, so what I'm here to do today is to go over what a 1031 is and the benefits of that. So we're going to cover a few things. This presentation is not going to cover every aspect of 1031s. It's going to give you a broad overview. Please feel free to reach out to one of the team members to ask if you have questions regarding this, and they'll reach back out to me and we can have a communication to answer any questions you might have. All right, so what I'm going to go over today is going to be what are the taxation rates that an investor is going to be faced with when they sell an investment piece of property. We're going to talk about the pros and cons of doing an exchange. What is IRC Section 1031, holding periods, what's like-kind property. I'm going to take you through how you balance an exchange, the process of the exchange, the identification rules, and then we're going to go over a couple of things that I'm seeing in the marketplace today. So let's start off with what is a 1031 exchange? Well, a 1031 exchange actually is a part of the tax code, and we like to refer to it as the taxpayer reinvestment plan, because what that means is when an investor sells a piece of property, instead of giving the state and federal taxing authorities money on the sale, they can use those dollars to reinvest into additional property. It's also a good tool for estate planning, where you can grow your portfolio, and then when your heirs inherit the property, they have currently a step up in basis in that property. So this is what a 1031 is. It actually truly is a part of the tax code itself. Now, I talked about paying taxes, so let's look at what the current tax rates are. When an investor has investment property, they're depreciating that property, which means that it's a non-cash expense that lowers the taxpayer's real estate taxable income while they're operating the property. So when you go to sell that property, there is a tax rate associated with that. And so the tax rate for the depreciation that you've taken over the course of the ownership is taxed at 25%. Then there's the capital gain rates. Now, there are two capital gain rates. There's the federal rate at 15% and 20%. So if your income as an investor, if you're single, is more than $441,551, you're going to be subject to the tax rate of 20%. If you're a married couple and your income is more than $496,601, you too will be subject to the 20% tax rate. Anyone else's income that goes below that 20% is going to be, let me say that again. Anyone's income below those dollar amounts is going to be taxed at 15%. Keep in mind, when you sell investment property, while your income may be less than these numbers I'm giving you, it can easily throw you into a higher tax bracket. Then there's the net investment income tax. That's an additional tax of 3.8%. If they're single and the taxpayer's income is more than $200,000, or a married couple $250,000, they're going to be subject to an additional 3.8%. So as you can see, at the federal level, there are three taxes that you can be subject to: recapture tax, capital gain tax, and potentially the net investment income tax. Any investor in the state of California is going to be subject to taxes. The tax rates in California range from 9.3 to 13.3. There are a few states out there that have no state income tax, but for any California investor that might have property in a non-income tax state, be prepared. You still have to cover California state income tax. So when we talk about doing an exchange, these numbers, these taxes can be take a huge impact on somebody's cash when they want to go out and reinvest. So when we talk about deferring, there's pros and cons. So you get to defer the recapture tax, you get to defer the federal income tax, you get to defer state taxes, net investment income tax. So that's an advantage to an exchange. Now, one thing you're never going to hear me say that this is a tax-free transaction, because it's not tax-free, it's tax deferral. When you're doing an exchange, you get to build your wealth. You can preserve the equity by not paying the taxes, both at the state and federal level, and you can also build your wealth by leveraging. There's situations where an investor may have maybe small debt or no debt on the property, but they go out and they buy larger valued property by using debt. So this is one way that an investor can use to grow their portfolios. Another thing that we see is diversification. The 1031 code allows you to diversify geographically as well as through asset class. So for example, if I'm selling a single family rental, maybe I'm ready for an apartment building now. Okay, so when we talk about like kind, which I'll get to a little bit later, it's not single family rental for single family rental. I can go from an apartment building to a shopping center and such. So I get to diversify by asset class. I also get to diversify geographically. So I can go from property in California and buy somewhere in Florida or in Texas or in Alabama or in Tennessee. I get to move my assets out of California and then get more valued properties elsewhere. Another advantage to doing a 1031 is going to be if I go into a property, maybe like a single tenant, triple net, or a Delaware statutory trust. Those qualify as like-kind properties in an exchange, and I don't have the management headache. Remember I said one of the advantages of an exchange was that it's great for an estate planning. What happens is if I, as a taxpayer, am investing in real estate, and I keep doing an exchange and exchanging, and then I ultimately meet the end of my life, my heirs will get the property under current tax law with a full step up in basis. The good news for my heirs is all the taxes that I have been deferring over the course of time is not passed on to them. So this is one way where an investor, if they're looking for estate strategies, can invest and defer the tax. So when their heirs inherit the property, they inherit it basically without having to pay the taxes that I have been deferring over the course of time. So those are the pros of doing an exchange. Now let's cover the cons of doing an exchange. Well, there are specific rules and guidelines that a taxpayer has to follow. We're going to go through that a little bit later. Another downside to doing an exchange is the replacement property basis. It's going to be lower. So what that means is if I do an exchange, so say I sell a property for $500,000 and my gain on the sale of that property is $200,000. That means my basis at the time of sale was $300,000. When I buy a replacement property of only $500,000, my new basis in that brand property is not $500,000. It's what I paid for the property minus the gain deferred. So if I sell for $500,000 and buy for $500,000, my basis from my old property moves directly with me to the new property. Now, if I bought higher or more property, then I can increase my basis that way. So that is one of the downsides to an exchange. Another downside to an exchange is lack of liquidity. And what I mean by that is that when you're doing an exchange, any cash that you keep or money that you do not reinvest, you're going to pay tax on that. So when you're doing an exchange, there's going to be certain rules that you're going to have to comply with. So that's what we mean by lack of liquidity. All the money coming out of this transaction needs to go into the replacement property. I cannot recognize losses. At this point right here, I would like to tell you that when you're considering selling investment property, it's important that you not only speak with, say, your real estate advisor, but also to speak with your accountant. Because when you talk with your accountant, what you want to know is, do I need to do an exchange or should I do an exchange? And your accountant should be able to tell you, based on what's going on the rest of your tax return, whether an exchange is beneficial or not. There may be instances where, as an investor, you might have some suspended losses. That's a time that you would be able to utilize those losses against the gain. And here's where I like to say, if you do not need to do an exchange, you don't do an exchange. So you want to make sure you consult your advisor to find out whether you have any losses that could be used against the gain. The other potential downside to an exchange is, do you think tax rates are going to go up in the future? That's going to depend. It's constantly fluid. And then, as I mentioned earlier, it's tax deferred. It's not tax free. Now, there are going to be 4 basic guidelines when somebody's considering an exchange. The first is going to be the property qualification. So is the property that you're exchanging property that was held for trade or business or for investment? So a 1031 is not about, primary residence transaction. It's about investment real estate transaction. The next requirement is how much money you have to spend for full tax deferral. When you're doing an exchange, you need to buy property equal to or greater than your sale price net the closing cost. You must spend all of the cash and replace any existing debt. Now, don't worry, I'm going to cover this a little bit deeper later. The next requirement is going to be the timeline for the exchange. Regrettably, you don't have forever to do this. You have 45 calendar days to identify after the date of closing, and you have 180 calendar days to complete the exchange. Both the 45 and 180 calendar day periods start at the closing of the sale. And then the last requirement that you need to meet is the identification rules. So you have to identify the property or properties that you would like to purchase as a part of an exchange. So let's go through all these basic requirements right now. Now, before let me step back for a second. You have to have a qualified intermediary in the transaction. So when you're considering doing an exchange, this is not something you can do by just selling and buying property. The IRS tax code 1031 requires the use of a qualified intermediary. So my role is basically, I will get assigned into your contract where I become the seller of the relinquished and or sale property. We do this through our documents. So when you get an escrow, we're going to request information from their closing agent or your escrow officer. From that information that we're going to receive, we're going to prepare the exchange documents. So basically, it's called the exchange agreement. Contained in that exchange agreement, it assigns us as the seller of your property. We tell the escrow officer to deed the properties directly to the buyer. And then when you go to buy the replacement property, we get assigned into that contract as well. So when you think of an exchange that's taking place between the qualified intermediary and the taxpayer doing the exchange. Also important with our exchange documents is that we restrict you from touching your funds. So basically, the money at the closing is going to come to us. You cannot use your funds for anything other than buying the replacement property. So this is called the G6 restriction. So it's very important, and that's one of the key components to the exchange agreement itself. Once you sign the exchange documents, we're now involved in the transaction. And just so we're clear, the qualified intermediary must be in place prior to the closing of the sale of the relinquished property. This is not something that can be done after the closing of the sale. Okay, another component to the exchange is that how long am I supposed to hold the property for it to be declared held for investment? Because this is about investment property. Well, what's interesting is there's actually nothing in the tax code that mandates a specific holding period. So there's a couple of things that you might want to look at for perspectives of time. One might be 24 months, where you could look to 24 months thinking that's a safe holding period. Well, because there was a revenue procedure that came out back in 2008. It was mainly addressing vacation homes, but it said in that revenue procedure, if the taxpayer owned the property for 24 months, then that would seem to be held for investment purposes. Another perspective might be if you've held the property for at least 12 months. When you hold an asset for more than 12 months, you now fall under the long-term capital gain rates. But the key term here is going to be, what is the taxpayer's intent? Because there are examples where a taxpayer has held a property for more than 2 years, in some cases more than 14 or 15 years. But their intent was never to hold it. Their intent was to develop it and sell it. So very important when you're talking to your tax advisor, have you held the property long enough to substantiate the held for investment intent? It's a common question we get all the time. Can somebody do an exchange if they've held the property for only 9 months? The question is, was your intention to hold that property for investment purposes? Were there other circumstances that, accelerated the sale of the property? Again, very important to have this discussion with your tax advisor, because that's the party that will be defending the transaction in the event you ever get audited. Now, when we talk about the basic requirements, we get into like-kind property. So what is what is considered like-kind property in exchange? So it's not single family home for single family home, apartment for apartment, not shopping center for shopping center. As you can see by this array of pictures here, like-kind basically means investment real estate for investment real estate, or real estate that I've held for my trade or business that maybe now I want to, buy something that I'm going to hold for investment. It's very, very broad, but the key term here is real property. It must be real property, okay? You cannot exchange something that is non-real property in a 1031. It's very specific for that. So hopefully that answers your question about what's considered like-kind property. Now, when we talk about the second requirement, as I mentioned, that you need to purchase property equal to or greater than your sale price net the closing cost. You need to spend all of the cash from the sale of the transaction and replace any existing loans. So here's my example. If I sell a property for $900,000 and I had a loan on the property at the time of closing of $300,000, I had closing costs, say, of $60,000. I had cash coming out of that transaction of $540,000. I go to buy a replacement property, say, of $1.2 million. I spend my full $540,000 in cash. I get a loan of $660,000 so that I can buy that $1.2 million property. So this is an example of using leverage to buy more. Now, while I know that this illustration only shows one property, you can do this by buying multiple properties and spend your cash, disperse it through multiple properties and leverage that way as well. So this is the criteria when you're trying to do an exchange to defer the tax. So in this example here, there is no boot. And when I use the term boot, it means taxable. There's two types of boot: mortgage boot and cash boot. Cash boot means you did not spend all the money. Mortgage boot means that you didn't buy enough property, that you didn't need to replace all of the debt on the sale. So that's what we call the exchange equation. Now, when we talk about closing costs, there are certain closing costs in a real estate transaction for an exchange that are acceptable expenses, and there are some that are not. So let's go over what's considered an exchange expense. That would be the real estate agent commission, the title insurance, any escrow or closing fees, any legal fees associated with the transfer of that property, transfer tax, notary fees, any recording fees, the qualified intermediary fees. So those are considered acceptable exchange expenses. Now, there's some expenses that are going to be involved in the transaction that are not considered exchange expenses. So, for example, prorated rents and security deposits. Now, you're going to see this more when somebody's selling maybe a duplex or an apartment building or a shopping center, where when you sell that property, the tenants are going to have some security deposits, and there's going to be potentially some prorated rents depending on the time of the closing. Those are cost of operating the property. So therefore, if you're crediting the buyer with the prorated rents or security deposits, that's money that the buyer's not bringing in, and therefore going to be taxable to the party that's doing the exchange. Also, if you're using exchange proceeds for points or prepayment penalties on loans, that's a cost of finance. That's not a cost of acquiring the property itself or the transfer of the property. One we see quite often, and that's paying the buyer's closing costs. It's not uncommon to see a transaction where the seller is agreeing to pay the buyer's closing costs. That's a potential boot issue. It doesn't mean that it can't get offset. You just have to know that that's a potential taxable event. Lender policies for the title company, if there's any impounds that need to be held or any reserves, that's something that I'm starting to see more often right now, depending on the product that people are buying. But lenders are looking to hold 12 months of reserves in certain instances. So that's a potential boot issue. Paying property taxes and insurance. Those are all costs of either financing the property or operating the property. So when you're doing an exchange, while you try to go for 100% tax deferred, it doesn't always work out. Always consult your tax advisor when you're looking at the closing statement so you can see where you may have some tax liability in that particular transaction. Now, the next thing I want to get into is the flow of the exchange and how this plays out. So what happens is you list the property for sale. I think it's a great idea that at the time of listing, or even when you're considering listing the property, it's important that you reach out to whoever's doing your taxes, your tax advisor. Also reach out to a qualified intermediary, someone like me. We're going to have two different discussions. Your tax advisor is going to determine whether you need to or should do a 1031 exchange, tax deferred exchange. The qualified intermediary, I'm going to explain the timeline to the exchange. I'm going to go through the process to tell you what you can expect. I'm going to explain the identification rules and everything associated with that. You get into escrow, you get the exchange set up. I coordinate with the escrow officer or the closing attorney, depending on the state that you're in, you're selling out of. I request certain documents from the closing agent. I'm going to request a copy of the fully executed purchase and sale agreement. I'm going to request a title commitment, and in some states, the escrow instructions. From there, we're going to prepare the exchange documents. The exchange documents are going to be sent to the closing agent as well as you doing the exchange. You need to sign those documents and return the signature pages back prior to the closing of the sale. Now, you heard me emphasize you need to sign those documents. The fact of us just sending them does not engage you in an exchange. So they must be fully executed. Believe me, there have been deals where people think, oh, well, I've got the documents, I'm set up. Not unless you sign the documents, you do not have an exchange set up at that time. The exchange documents come back. The buyer brings in their money when they're ready to close. At that point, the deed will go directly to the buyer. The money will come to the qualified intermediary, and then the time frame for the exchange is now going to officially begin. This is when the 45 and 180-day period starts. The hard part to the exchange is going to be the 45-day identification period. I'm going to cover that in the next few slides. But let's just take you through the full process of the exchange. When you go out and you get under contract with the replacement property, we get assigned into that contract. We prepare our exchange documents on the purchase side. When you're ready to close, we're going to wire the funds into that closing. Obviously, if you're getting a loan, the lender's going to bring their money in directly to the closing agent. The deed is going to come directly to you at the closing. So as you can see, that's the flow of the exchange. So the money is filtered all through the qualified intermediary, and the documents are prepared on both the sale and the purchase side. Because remember, the qualified intermediary has to be the seller and has to be the buyer, although we never go on title to the property in a forward exchange. Now let's go over the identification, because that's the hard part to the exchange. So there are 3 rules that you get to choose from. The first rule, and the most commonly used rule, is the 3-property rule. Under the 3-property rule, you can identify physically 3 addresses. The fair market values of those properties, it doesn't matter. There's no limitation to that. So if I sold something, say, out of Orange County, say for $900,000, I can identify an apartment building, say, for $1.5 million. I can identify another property for $1.2 million. Okay, or I can identify one for $2 million if I chose to. No problem, as long as I'm staying within 3 addresses. If I wish to identify more than 3 addresses, so 4 or more, now I have to be very careful, because now the fair market values of all of those properties I'm identifying comes into play. Under the 200% rule, I can identify 4 or more properties, but when I add up the fair market values of all of those properties, it cannot exceed 200% of my sale price. So if my sale price was $900,000, I can theoretically identify 4, 5, 6, 7, 8, depending on where I'm going, up to $1.8 million in total value. And at that point, I can choose whatever, whichever properties on that list, I can buy those properties. I do not have to buy them all. Now, if I got carried away and the aggregate values of more than 4 properties exceeded the 200%, I'm now defaulting to the third and final rule, which is the 95% rule. Under the 95% rule, unlimited properties, unlimited dollar amount. Now, before you get too excited about that, here's the catch. You have to close on 95% of the values of all the properties you have identified. So in effect, you need to purchase your entire list. That is a rule that is very, very rarely used, and it's only used when people feel very comfortable that they can close on everything that they've put on that list. So let me show you what an identification form looks like. The identification form, I like to say that there's the technical and there's the practical. This form that you see right here is the actual identification form itself. This is something we at Asset Preservation are going to provide you, when you do an exchange. The key is with the identification form is it has to be sent in before midnight of the 45th day of the exchange. So that's when you're going to have to fill out the address, the city, and the state of the property or properties that you would like to acquire. If you're doing 4 or more properties, you're going to have to put in the dollar amounts as well. Now, it is not a requirement that you be under contract with any of the properties that you've put on the list. But here's where I'm going to caution you. You can only purchase any property or properties that's on that list. So from a practical standpoint, it's important that you be under contract with something that's on your list that you're providing for the identification. So again, this is the hard part to the exchange. Most people aren't going to fill out the identification form until they get closer to the 45th day and feel very comfortable about the property or properties that they would like to acquire as a part of the exchange. And that's the great thing about working with, with the teams and Marshall Reddick, is they can help you with this because they have properties that you can pretty much plug and play. So it takes some stress off of this process as it unfolds. Now, so I want to show you some examples of what it actually looks like. So under the 3 property rule, I would be filling in the address, the city, and the state. So as you can see in my first 2 examples, 123 Main Street, Culver City, California. That's correct because I have the address, the city, and the state. The second one, 22 Surf Avenue, Marina del Rey, California. It's a perfect address, city, state. The third one I have 9898 342 Place, Norco, but I didn't put the state. So is it Norco, California, or is it Norco, Louisiana? You must put the state. Now, here's something to caution you. If you decide to purchase in co-ownership with someone else, not in a partnership, but in co-ownership with another party, you're not going to be identifying the whole property. You're only going to be identifying the percentage that you're going to be buying. So say, for example, Sherry and I go out and we buy a piece of property together and we say we're going to be 50-50. Well, when I fill out the identification form, I'm going to fill out my identification form saying, 123 Main Street, anywhere USA, 50%, because I am not buying 100%. So you have to be careful with the identification when you're buying with a co-owner. Here's the example of the 200% rule. So as you can see in this example, I have 5 properties listed. I have all the dollar amounts listed for each and every one of the properties that I'm going to buy. Now, people say, well, where do I get that dollar amount? Can I make it up? Well, you can if you want to, but you better be very, very careful because you can only buy, you can't put in a smaller dollar amount and then go out and buy the same property for a lot higher just so you could fit into the 200% rule. Okay, you can't do that. So you got to be very, very careful. So usually people are going to use either what they're willing to pay for the property and or maybe what the property has been listed for. So in my example, I've got these 5 properties. I add them all up. it comes to 995,000. My sale price was 500,000. So I'm within the 200% rule, which would have been $1 million. So I can buy whatever combination I need to make my $500,000 exchange. Okay. I can buy 4 of them. I can buy 3 of them, whatever the numbers, however the numbers work out. And then here's an example of the 95% rule. So I have my 5 properties, but when I add them up, I exceeded the 200% rule. So the aggregate value now is $1,045,000. So in order to comply with the 95% rule, I'm going to have to close on the total of $992,750. So as you can see, based on these purchase prices, I have to buy my entire list in order for me to comply. Again, do not go toward that rule. That's a rule that you don't want to go toward. So there's a lot of planning. I'm going to pretty much know what rule anybody's going to be using based on where they're selling and what they plan on purchasing. So again, this is all part of the conversation when we're talking to you about how the exchange works. Now, let's talk about something also that comes up where people are looking to maybe consolidate. So an investor might want to sell, 3 properties. Maybe they want to go out of going from single family rentals, maybe to go into apartment buildings. They're wanting to build up their portfolio. So they're saying, okay, well, I need to sell these 3 properties in order for me to buy this one apartment building that I wish to acquire as a part of the exchange. You can do what's called a multiple property exchange. But what's important to understand is that the time frame for the exchange is going to begin at the closing of the first property. So what that means is that if property 1, say, closes on June 15th, and my next property is scheduled to close on June 26th, and my third property is going to close on July the 2nd, well, I feel relatively safe there because those dates are not that far apart. But if I have one property that's closing on June 15th, another property closing on June 26th, but that third property I don't have under contract yet. I don't have a buyer for it. And maybe the market's not as strong. Maybe there's not as many buyers. I might get a little concerned. Is that third property going to close in time? So it's very important when you're considering something like that to be practical and realistic about, can you get this done based on what you're trying to accomplish. I've had transactions where people have sold 4 properties in 3 different states, and that can get a little challenging because you've got potentially 3 or 4 different real estate agents that are working on the transaction. Some buyers and sellers in marketplaces are a little bit different. And the key here is that you get that final property closed before you have to close on the replacement property, because the 45-day identification period and the 180 days is going to start at the closing of the first property. So if this is something that you're thinking about doing, we have to have a very long conversation about the practicality and the realistic foresight of how this is going to play out in the exchange. What we see that's quite common is people are selling one property and buying multiple properties. A lot of folks, exchanging out of California, selling here, buying elsewhere, because you can buy so much more in other states. We're seeing multiple replacement properties on these transactions. All right, so that's totally doable. The thing you have to be careful of is the identification rules and which rule you're going to be using. My example here shows you 3 properties, but if you wanted to buy, 12 or 15, then you're going to either be in the 200% or the 95% rule. And you need to make sure that you can close on all of those properties to complete your exchange by the 180th calendar day. Again, planning and being realistic as to whether this can be accomplished or not. Again, we'll have a conversation with you to go over everything. All right, so let's just talk a little bit about what we're seeing, in the marketplace today. Even all our world has been turned upside down, it seems like, since March. We're in a different spot right now. but inventories are still low in a lot of places that I'm, seeing. So you have to be aware of, what's the inventory level where you're going. Again, this is one of the advantages of working with the network, is because they can help you with these issues. So be aware that, because inventories may be low in certain areas, they may be, a little bit more loose in other areas, but it's something to consider when you're doing an exchange, because when you're dealing with the exchange, you have to identify what you're going to be buying, during the first 45 days of that identification period. We talked about purchasing and selling multiple properties. One thing I would like to just mention on this section right here is the fact that if you're buying, and sometimes people ask me, well, Dino, do I have to take my money, say I've got $300,000 of cash and to put down on the new properties. Do I have to put equal $100,000 on each new property if I were buying 3? And the answer to that is no. You can divide your cash, you disperse your cash and your loan, whatever way you want to do that when you're buying multiple properties, as long as aggregately you've spent all of the cash and you've replaced the existing debt. Okay, so it's not that you're required to distribute the cash coming out of the exchange equally amongst the properties. You can do it whatever way you want, as long as you're meeting the criteria of spending all the cash and replacing the debt. Now, the next thing is very important with the exchange transaction itself, is that when you're doing an exchange, the same taxpayer selling must be the same taxpayer purchasing. Okay, so there's certain ways that we hold title to property, the vesting of a property. In some cases, we might hold it in an LLC. We might hold it in a revocable living trust, just 2 examples. If I'm holding a property in my revocable living trust and I go to sell that property and the lender says, Dino, you can't buy this property in your trust, you have to buy it in your individual name. As long as my trust is disregarded, so a revocable living trust usually is, okay, I've not seen one that isn't, but it means that I am the taxpayer. That trust is there just for estate planning purposes, okay? So if I have to buy the replacement property in my name as opposed to my trust, I'm fine for the exchange, okay? If I'm in an LLC where I am the member of the LLC that's also disregarded, I can buy into my individual name if I want to. Now, if I have a husband and wife that are living in a community property state and they have an LLC where they're the members and the husband and wife have selected to be treated as a disregarded entity, you can do that if you're living in a community property state. But there are instances where the husband and wife have chosen to be taxed as a partnership. Now, here's where it can get very, very interesting. If they have chosen to be taxed as a partnership and they're going to buy a property, say, for example, 1-to-4 financing becomes a problem with a partnership. Okay, if you're buying an apartment building, not so much, 5 units or more, because that's commercial financing. So when you're thinking about the exchange and we're having the discussions early on, if there's an instance where you're holding title in an LLC taxed as a partnership and you want to buy, say, 1-to-4s, it's important that you loop in a lender early on so you know what your lending options are going to be. Because even though you might be husband and wife, you cannot buy the replacement property in your individual name. For the exchange purposes, the LLC is the taxpayer doing the exchange. Okay? Also, if you're in a partnership, not necessarily husband and wife, but maybe Sherry and I got into our own partnership, and we're selling the property, and we say, okay, we're gonna go our separate ways now. I cannot do an exchange with my partnership interest. Okay, the partnership can do the exchange, but I cannot exchange my partnership interest on this in a situation like that. So it's very, very important when you're having the discussions early on to understand what your requirements are going to be for who's the taxpayer selling and who's the taxpayer purchasing. Partial exchanges. You can do a partial exchange, totally fine to do that. The key here is that you want to make sure that you're still benefiting from the exchange. So in other words, if I want to do a partial exchange and say, I want to take $100,000 of cash out of the property and I just want to reinvest the rest. Okay, that's fine, potentially. But what is my gain on the sale of the property if I didn't do an exchange? So if, for example, my gain was $100,000, but I want to take $100,000 of cash at the closing, there would be no reason for me to do an exchange because I would pay all the tax as though it was a sale. But if my gain on the sale of the property was $200,000, then I'm still protecting tax on the other $100,000. So you can do a partial exchange, but you want to make sure that it makes sense to do. And you also want to make sure that you understand that the minute you touch that cash can never be put back into the exchange tax deferred. So make sure you know what you're doing at the closing, okay? You want to make sure that that's how you're handling it. Investor versus dealers, a 1031 is a tax code for investors, not for a dealer. So a dealer would be someone that buys the property mainly to fix it up and sell it, or to build it and sell it. They do not qualify for 1031 tax deferred exchanges. There's also a thing called a reverse exchange. Reverse exchanges are available, but I will tell you they're not always doable. That is an exchange where a taxpayer has to close on the purchase before they close on the sale. So, very expensive exchange. If this is something that you might be looking that this might happen in your transaction, I cannot say strongly enough that you need to speak with somebody like me very early on, because these are complicated, expensive exchanges, and there's a lot of lenders that will not allow for us to go on title to the property. Because when you're doing a reverse exchange, we as the qualified intermediary are going to be the ones on title to the property, not you, the taxpayer, doing the exchange, because you cannot be on title to both properties at the same time and call it an exchange. And then lastly, this has been around since 2014, but you just have to be aware that when you're selling in California and you're buying out of the state of California, you're going to have reporting that's going to have to be done every year. It's the FTB 3840 form. No big deal. Just remember that you have to file that form every year, that you still own the property and you haven't cashed out in a sale transaction. All right, because California has a clawback provision, and this is their way of monitoring it. So that's pretty much we're getting to the end of all of this. When you're talking about doing an exchange and selecting a qualified intermediary, there's things that you need to know. First of all, our industry is not regulated, so you want to make sure that who you're working with has been around for a while. Is there procedures in place for monitoring funds and depositories? Whose funds are the name, whose name are the funds held in? What are the requirements for any deposits and withdrawals? Are the qualified intermediaries audited by a third party? Who backs them, and are they complying with any state laws governing qualified intermediaries? I can tell you Asset Preservation's been doing this since 1990. We have facilitated over 190,000 exchanges nationwide. Stewart Title happens to be our parent company, and they've been in business for over 120 years, I believe. So they back what we do. And we do have fund management. We do have audits internally and externally, and there are requirements for withdrawing and depositing funds. So, so we do comply. Those are some of the things you want to look out for when you're dealing with a qualified intermediary. How long have they been in business? What's the security, and what's their experience? So with that being said, my contact information here, if you have any questions, feel free to reach out to Sherry. She can reach out to me, and we can be in communication. I want to say thank you for the opportunity to go over the 1031 tax deferred exchange process. Everybody's situation is going to be a little bit different. Happy to answer any of your questions to help you throughout the process. So thank you, Sherry. Appreciate the time.
Thank you so much, Dino. So much great information. She is total wealth of knowledge. Just on a side note, Dino and I are working on a 1031 exchange right now. She is definitely the go-to person, knows her stuff backwards and forwards. So we're very fortunate to have her as part of our team. Where to go from here? We've given you a lot of information in a short period of time. I know most of you are going to need more information. This is just the tip of the iceberg. So definitely call us, text us. We'd love to set up a consultation, just if you want to ask a few questions. Love to hear from you. You can contact me. You've got my cell number on your screen, my email address. Definitely get in touch with me, get in touch with Dino. We'd love to hear from you. Love to answer your questions. And also wanted to, just as a side note, take a look at our Marshall Reddick website. I've got a screenshot up there right now. This is a wealth of knowledge for everything related to residential real estate, investing, financing, anything you need to know. You can search a subject and you will find a wealth of knowledge, whether it be pre-recorded webinars, documents, whatever it is that you're looking for, however it is that you enjoy learning, it'll be there for you. I highly recommend you spend a few minutes just on our website looking at that. Click down on that Learn tab under Education and take a look and see what there is to offer. As a side note, this webinar will also be on that website if you want to refer back to it later. So definitely, I do encourage, the more information, knowledge is power, and I do definitely encourage everybody to check out that website and teach yourself. This is all free and very valuable information. Also, speaking of the free and valuable information, we have a property rating ebook, which is key when you are looking at investing in properties out of state or even here in California. This is, once again, it is a free downloadable ebook. It explains how we rate properties. It explains what you should be looking at if you want to rate your own properties. This is definitely something that it's head and shoulders above what any other brokerage is going to be able to provide to you. So I strongly encourage, the more information, knowledge is power. I strongly encourage you spending a little bit of time downloading the book, take a look, and you'll take away at least one or two good points that you'll always remember. That's exactly what you need to be doing. So I want to close and thank Dino once again. Hope you enjoyed our afternoon together. I know I did, and would love to be hearing from you guys. I will probably be reaching out to you individually and seeing if I can answer any questions. But for now, enjoy the rest of your day, and we'll be talking soon.